The stickiness of rent. We all know this huge uproar in New York City about it. Williamsburg is a small enclave out to the east of Manhattan. And there was an apartment listed for a cheap $3,500 and went in a frenzy at $4,050. How do we bring down rents in America?
So this is one of the ironies of this Fed rate hike cycle. The Fed is actually, through raising rates, disincentivizing home builders in an environment where we have a shortage of housing supply. So I think it's very likely over the next year, we continue to see rents putting upward pressure on inflation. And, we're going to get, I think the data this week is going to be focused on housing. Clearly, housing sales are going to continue to moderate. But this is one of the, I think, inconsistencies of the Fed's rate hike activity with their goals, and one of the ways in which they're kind of facing a different inflation demon than they are used to. Not coming from wages.
This raises some important questions, and Connor Sen and on Twitter has asked this question too. What is the optimal way of using realized inflation data to make a forward-looking monetary policy decision?
To me, we are focusing so much on this monthly University of Michigan number, which in reality is so sensitive to gasoline prices. And so I think we made too much of it when it went up. We're making too much of it when it comes down. The market indicators are more contained when it comes to inflation expectations. But when we look at inflation right now over the next year, a bottom-up approach is really best. Not the Phillips curve dynamics that drive inflation over the long run, but really taking it apart. And when you do that, you do not have durable goods deflation. You do not have energy price deflation. It is virtually impossible to craft a story where inflation comes neatly back down to 2%. So much has to go right to get inflation to behave well.
Okay, well, one of those factors obviously is going to be the Federal Reserve hiking rates, trying to rein in demand, Laura. And the question really surrounds how much the economy and the American consumer in particular is going to be able to tolerate. And if you ask big bank CEOs, they're looking fine. We're just hearing from the CFO of Bank of America, Alistair Borthwick, saying the U.S. consumer spending levels remain high. They delivered the highest quarter ever for spending in the second quarter. They sound quite optimistic. How optimistic are you on the U.S. consumer?
I describe the U.S. consumer as resilient, and I think there's better foundation for growth going forward. I think the household, looking at what's driving household spending, a lot of those components are still there. But when you back out inflation, it's clearly crowding out other discretionary spending. So again, a place where inflation in and of itself is cannibalizing other demand. When you are looking at a retail sales number, it's solid, but you back out the inflation impact, real consumption is slowing. It's not in negative territory, it's not contracting, and that speaks to the resilience of the consumer. Because look at our economy versus a lot of the rest of the developed world. We're still in better, standing. We're still have better economic activity.
So Lara, does that mean the Fed needs to do more?
I think they need to go fast to neutral, get there, and then they need to become more data dependent. They need to give these rate hikes time to work on the economy and not be so reliant on the models that are really constructed for, prior episodes where we don't have inflation coming from the disruption in supply chains, from all of the unique pandemic-driven inflationary factors. So I would be a favor of fast to neutral, even a little bit beyond, get us to 3%, and then take a minute and see how the data respond and realize that we're just in a very different environment. I don't think there's enough acknowledgement on that from the Fed.